right, welcome back to another episode of Who Charted, coming to you a week early due to various travel schedules. However, the Research by Potomac team, myself, Dan Russo, as well as Drew Wells are here and ready to go for the most exciting 6 minutes in markets. 6 charts, 6 minutes. Drew, what do you got to kick us off?
All right, coming at you with a chart of the Bloomberg Commodity Index. I know this has got to be a real shocker for a lot of you who follow our work that we do. Is the S&P 500 in the middle pane here and the rolling 6-month correlation with these two indices in the bottom pane here. So talked a lot about commodities, obviously, in our work lately. And, you don't have to be a technician to figure out that these relationships really started to diverge at the beginning of the year this year, obviously with equities trading down, commodities trading up. But I think another arrow in the quiver of commodities could certainly be the relationship that it has with stocks. So it's a risk asset. I think a lot of people think that they need something to be completely negatively correlated, in a portfolio for it to perform well. There's a lot of debate around this, but arguably you'd really want something kind of in that neutral range, floating somewhere around zero. And that's really right where we're at, with the commodity index and the S&P 500. So could that be a driver that drives flows in the future? We don't know, but it's going to be interesting to see.
Speaking of the S&P 500, here it is, just a weekly chart of the S&P 500. Green line gives us a 40-week moving average, red line 10-week moving average, so roughly the 50 and 200-day moving averages. We've written a lot about this. Obviously, we highlight it every week in our work. 4,200, the key level. The question is, what if 4,200 breaks? Just kind of doing some basic Fibonacci retracement work from the COVID low to the recent high. A 38% retracement gets you down to around 3,800. 50% retracement gets you down to around 3,500. And a 61.8% retracement of that entire advance brings you back to the initial gap lower of the COVID pandemic sell-off. So just some interesting levels. I'm not saying we're going there, but if we start thinking about what happens if 4,200 breaks, these are the levels that I would have on my radar screen for potential downside objectives.
All right, we didn't plan this, promise. Dan mentioned 4,200, which is really interesting in the S&P. This is a green line here on the chart is capitulatory breadth. So we look at stocks that, are very stretched from a volatility metric, and we look at periods of time where the S&P 500 components are extremely highly correlated, right? They don't happen a lot. There's only a handful of signals really in the past few years. We got one on March 8th, right? And despite the sell-offs of Thursday and Friday of last week, we really haven't seen this extreme blowout capitulation in market breadth, at least measured by these metrics, right? There's a lot of different ways to measure it, but take a look at right where that was at, right? 4,150, right in that 4,200 range. So I think that kind of lends a little bit more credence to, that area being tested, but it's going to be really interesting to see what kind of price action develops from there.
So yeah, kind of a lack of capitulation is something that we've been highlighting a lot. Something else that's interesting, however, though, is, it is a market of stocks. Everybody's focused on the S&P 500, but, within the, more aggressive areas of the market, maybe the NASDAQ 100, for instance, QQQ, the ETF there, it's kind of been lagging for a long time relative to RSP, which is an equal weight S&P 500. So the Qs relative to the average stock in the S&P 500 has essentially gone nowhere for almost a year, and is actually in the process of breaking down. So while the S&P 500 hasn't broken support yet, obviously there are pockets of the market that are underperforming. This is one of them. Now, it's a huge week for the Qs this week in terms of earnings. We're not as focused on that. We're focused on this trend and the potential breakdown here of below support for the Qs relative to the average stock in the S&P 500.
All right, low volatility. This has been a theme that I've been kind of beating a dead horse, I think, for ever since my time here, really, with the firm since Q4 last year, right? So you guys have seen me put this chart out a lot. S&P 500 low vol relative to the S&P 500 top pane. International low vol relative to international developed on the bottom pane right there. So what's interesting is that at least over the last year or so, international low vol has actually led domestic low volatility, right? So we've broken out to the upside above relative resistance after a retest, above a rising now 50 and 200-day moving average domestically. Take a look at international here, the ratio on the bottom pane. Still haven't tested those March highs. I think, we've got a little bit of headroom to retest that relative resistance level, but it's going to be really interesting to see what the risk appetite plays out around that level and whether or not that translates into weakness domestically.
All right, finally, we've talked a lot about the emerging positive correlation between stocks in bonds. And, as equities have been under pressure, fixed income has not provided a port in the storm, right? Treasuries have been under pressure. Most of the fixed income market's been under pressure. Drew has touched on it in his weekly macro scans notes every Monday for probably the past 4 or 5 Mondays right now. But you know what has been a port in the storm? The US dollar index, which is kind of fascinating to me because in this world of increasing inflation, the hardcore Bitcoin people will tell you Bitcoin is the perfect inflation hedge. The hardcore gold people will tell you that gold is the perfect inflation hedge. Well, with the CPI pushing around 8%, neither one of those assets is acting well. But we have the dollar index pushing up towards recent highs. So I think that this one is providing the port in the storm, and it kind of starts to blow up a few inflation narratives while we're out there.
All right, everybody. Thanks so much for spending some time with us. If you like this content, please like and subscribe, and we'll see you in the next video.
Thanks, everybody. We'll see you soon.
See ya.